Have you ever felt like there's some kind of hidden code to the stock market? A set of rules that could actually explain why some stocks soar and others, well, don't? Today, we're going to dive into a model that claims to have cracked that very code, and in the process, it completely changed how we think about investing.
For the longest time, investors were basically navigating with a really incomplete map. I mean, the smartest people in finance had a theory about what drove stock returns, but it was just full of holes. It couldn't explain these huge market movements, leaving a lot of people just guessing in the dark.
So that old map was called the Capital Asset Pricing Model, or CAPM for short. And look, it could explain about 70% of why different stocks had different returns. Now, that doesn't sound too bad, right? But in the world of finance, that 30% gap is a massive gaping mystery. But then, the Fama-French model shows up, and suddenly that explanatory power jumps to an incredible 95%. It filled in almost all of the blanks.
The real problems with that old model, with CAPM, they really started to pop up in the 70s and 80s. Researchers just kept running the numbers, and they found this one major flaw that became totally impossible to ignore.
You see, CAPM's whole idea was super simple. The more risk you take on, the higher your reward should be. Makes sense. But here's the thing. Researchers kept finding these two specific types of stocks that were consistently crushing the market, but they weren't nearly as risky as the theory said they should be. We're talking about small companies and these so-called value stocks. And the old model, it had absolutely no answer for why they were such reliable winners.
So, this huge mystery basically set the stage for two researchers, Eugene Fama and Kenneth French. And in 1993, they didn't just tinker with the old model. Oh no. They pretty much tore it down to the studs and rebuilt it from scratch, introducing this groundbreaking three-factor model that finally started to make sense of everything.
Okay, so the first thing they did was really smart. They kept the one part of the old model that actually worked, market risk. This is just the basic idea that if you're in the stock market at all, you're taking on risk, and you should get paid for it. It's kind of like the tide that lifts or sinks all the boats together.
But then, they added their first revolutionary ingredient, the size factor. They call it SMB for small minus big. And this captured something people had noticed for a long time, that over the long run, smaller companies have historically delivered better returns than their giant, big-name counterparts.
And their third key piece of the puzzle was the value factor, or HML, for high minus low. This tracks the tendency of stocks that look cheap compared to their net assets, their book value, to actually outperform those expensive, high-flying growth stocks over time. It's really all about finding those diamonds in the rough.
But of course, the story doesn't stop in 1993, not even close. Like any really good scientific theory, the Fama-French model wasn't just set in stone. As we got more data, as new patterns started to show up, the model itself had to evolve.
Right, so that three-factor model from '93 was the big revolution. But by 2015, Fama and French themselves came back and expanded it to 5 factors to explain even more of what was going on in the market. And the search's still on. Researchers today are pushing it even further, proposing even more complex models.
So that fourth ingredient they added in 2015 was profitability. And this one, well, it's almost just common sense, isn't it? The idea is that companies that are actually really good at making money, the ones with robust profits, tend to give you higher returns than companies that aren't so profitable. It's basically a quality check. The fifth and final piece was investment. And this one's a little bit counterintuitive. It turns out that companies with more conservative investment strategies, the ones that aren't constantly making huge splashy acquisitions, they often outperform the firms that are investing super aggressively. A little bit of caution, it seems, can really pay off. Now, you might be thinking this model sounds perfect, right? The ultimate answer. Well, not so fast. For all of its success, the Fama-French model has had its fair share of critics. From the very beginning, it has sparked some really intense debate. I mean, on the one hand, its strengths are just undeniable. Being able to explain 95% of returns, that's huge. And it gives investors real, practical tools to build smarter portfolios and, this is really important, to figure out if their fund manager is actually any good, or if they're just getting lucky by riding one of these factors.
But, and this is a big but, the critics ask a really tough question. Is this a real discovery about how markets work, or is it just data mining? Torturing the data until it confesses to a pattern that's not going to repeat in the future. And honestly, while we know these factors work, the deep economic reason why they work, that's still up for debate.
And get this, Fama and French themselves were the first to point out their model's biggest weakness. They straight up admitted that their model's inability to explain momentum, that powerful tendency for winning stocks to keep winning, was, in their own words, the main embarrassment of their original theory.
So this whole debate got really heated in the last decade or so. Why? Well, because some of these key factors, especially value, went through this long, painful stretch where they just stopped working. It led a lot of people to wonder if the model was finally, officially broken. And I mean, this is how bad it got. In the US market, the value factor did so poorly that for the first time in history, its 20-year performance against the S&P 500 actually went negative. It felt like one of the fundamental laws of finance was just crumbling before our eyes.
And then, just as everyone was writing the obituary for value investing, it came roaring back. And this is so typical of how these factors work. These long, quiet periods can set the stage for these incredibly powerful comebacks. We saw a perfect example of this recently, as the slide shows, especially in markets outside the US. This chart just says it all. While the S&P 500 was basically flat, treading water, an international value fund was up nearly 18%. And this wasn't just some lucky break. It was a massive, whiplash-inducing reversal that totally echoed these historical patterns where a factor can just go to sleep for years, maybe even a decade, before it wakes up and comes roaring back.
So, what does this all mean for you? What's the takeaway here? Well, first, the market isn't just one thing. Returns are driven by all these different dimensions. You've got to understand what your portfolio is exposed to: size, value, quality. And maybe the biggest lesson of all is that these factors reward patience. They can vanish for years, but then show up strong, and they often perform very differently all around the globe. Which really leaves us with this one big final question. The Fama-French model has given us this incredible, invaluable map, way better than anything we had before. But as investors, we always have to remember that while the map is brilliant, the territory it describes, well, that's always changing.